Folks, we're in the home stretch here. The class next Monday, your project is due. Next Wednesday, final exam. I want to clarify a little bit about the timing issue, because the problem is it's like trying to nail jello to a wall, right? You think you're done and the world shifts under you. And unfortunately for you, you've gone through 3 or 4 weeks of incredible volatility in the market. So you did your DCF at the end of March and found your stock to be overvalued. Surprise, today you look at that same stock, 40%. You value Netflix, it's undervalued. That's frustrating, but it is like, it is the way investing works. Now, if the email I sent yesterday said, whatever date you did your DCF value in this, I'm okay with it being in March or April or wherever you did it. But the only comparison that matters is the comparison right now. Of course, you don't wait till May 6th to write your final project. Yeah. You've got the mic open, could you please? Mine is on. So you can't hear me?
I can hear you.
Okay. So. Now, obviously, you can't wait till May 6th to do your final project report. So we get it done today, tomorrow. So anytime this week, if you want to make that your final date, go ahead and make that your final date. Put that in as your date of valuation, put the prices of that day. But if you're going to wait till the weekend, Friday evening will obviously be the last closing price that you can conceivably use. Your recommendation will have to reflect the price then. The reason I bring this up is I was looking at the master spreadsheet and I noticed things like valuation was done as of December 2021. You either value the company before you came to this class, or you're using the fact that your annual report ended on December 31st, 2021 as an argument for that. Now remember, that annual report didn't come out even as in terms of information until February or March. So I think you got to think about your valuation as being as of right now, even though you can't keep updating your numbers. The one number you might need, it's almost effortless to update is the equity risk rate, which is from 4.24% to whatever it is now, and you can kind of update it, leave that number if you want. But nail the process down. If it's today, tomorrow, that can be your final date. If it's May 6th, make that your final date, but don't make it as of January 1st, 2022, because there's nothing that can be done with a recommendation that's 5 months old. Any other questions about the project? Final exam, of course, May 11th. It is cumulative. With everything in the class, and you go through the slides, 800 slides, a lot of material, 3 quiz materials. My recommendation is you work backwards preparing for the final, which means cover the topics for the final that we haven't covered. The acquisition valuation, which we're doing today, value enhancement Wednesday. The real options, obviously, we haven't covered. Those are the 3 topics. Start with that first, and then I would go back and review quiz 3. And then you'll notice as you review quiz 3, you're also reviewing quiz 1, because a lot of bottom-up pages and cost of capital show up over and over again. So work backwards, and of course, I sent out the past finals if you want to try them out. So today we're going to talk about acquisition. Now, any of you work? Any of you work in M&A in your previous lifetimes? No M&A people? Anybody planning to work in M&A? The next 80 minutes, the most depressing 80 minutes of your life, but kind of set it aside so you don't have to give up your job, obviously, but it's at least to get realistic about the area you're going into. Let's step back, right? Think about a friendly merger between 2 publicly traded. There are 6 players in this game. Let me go through the 6 players. There's a CEO that manages the acquiring company, the banker helping that manager, the shareholders in the company, the acquiring company. Same thing with the target company. The CEO / management of the target company, the bankers in the target company, the shareholders in that company. Only 4 of those people are actually in the room when the deal gets done. Right? For the 2 that are not in the room, the shareholders are not in the room. The managers, the bankers, the acquiring company, the managers, the bankers of the target company. Of those 5 players, there's one group that consistently loses whenever you have M&A between 2 publicly traded companies. Which group is that? Shareholders, which company? Acquiring company. In fact, if you're given a choice, you'd like to be shareholders of the target company. I'm going to start with a chart that brings it up. I mean, there have been hundreds and hundreds of studies that look at look at stock prices around acquisition announcements. And if they track what happens to stock price of the target company, that's the red line, and what happens to stock price of the acquiring company, the blue line. First, if you look at the target line, the day 0 is the announcement day. So in theory, no news about the announcement actually is available before day 0. The reason I say in theory is I come back and look at this, and obviously there's a jump in the stock. But notice that even though in theory there's no news, there is really some kind of drift happening before the actual announcement. Now, you can call this insider trading, you can call it information. No matter how much the SEC tries, there will be some leakage that happens before an announcement. The bottom line is target company stock prices jump by 15 to 20% on average across all acquisitions on the day the acquisition is announced. The acquiring company, though, not much happens, not much happens. In fact, if you look at the collective effect over the entire time period, acquiring company stock prices drop by about 2%. You're saying this is good. Target companies drop 15%. Acquiring companies drop only 2%. This is a net plus for markets, right? What am I missing when I say that? Target companies drop 15%. Acquiring companies drop the relative market cap. Acquiring companies tend to be much bigger than target cap companies, right? So if they are 10 times bigger, 2% drop in the market cap of your company. You know, the day that Microsoft announced its Activision bid, Activision stock price obviously jumped about 25%. Microsoft stock price dropped about 2%. But 2% of a $2 trillion company is a lot of money that's leaked out of the company on the day of the announcement. So that's the first thing. When you look at publicly traded companies and you look at acquisitions, target company shareholders clearly win, but acquiring company shareholders are more likely to lose than win. In fact, in 55 to 60% of all acquisitions, the acquiring company shareholders see a drop in the stock price at the time of the announcement, which is kind of an indication the market thinks you pay too much. That's really it, right? Now, of course, we asked the managers of the 2 companies, remember it's a friendly merger, they want the merger to go through. Their response is markets don't see what we see, which is what all the internal cash flows and the synergy projections and all the numbers we've come up with, they don't have as much information as we do, which is absolutely true, right? Managers do have access to internal information about the costs you can cut and the growth you can have. So their argument is they just don't see. But here's the interesting follow-up as to which group is actually more likely to be right in the long term. There are studies that look at what happens in the 5 years to 10 years after a merger is completed. Remember, this is when the synergy is supposed to show up, earnings are supposed to go up. So if the companies are right and there is synergy and there are cost cuts and higher growth, you should see it in the actual numbers in the years after. So if the market's being short term, let's see if in the long term mergers actually there. McKinsey used to do studies almost every other year looking at acquisitions, asking a couple of basic questions. The return on capital and acquisitions exceed the cost of capital. It's the question we ask about any investment. The return on capital exceed the cost of capital. Second, did the acquisitions help the parent companies outperform their peer group? The margins increased relative to the peer group. And when they asked these questions, they found that half of all programs failed at least one test and a quarter failed both. So when McKinsey looks at the actual numbers after the merger, the numbers don't seem to bear out all the promises that are made at the time. Toward the end of the 1990s, KPMG did a study of almost 8,500 acquisitions that were motivated primarily by synergy. And that's a very simple question. In what percentage of these mergers does synergy actually show up? Because the essence of synergy is the combined firm in the years after the merger do much better than the two individual firms were doing coming in. And they concluded that more than 80% of all mergers failed to deliver synergy. In fact, in half of all the mergers they looked at, there was reverse synergy. You know what that means? Two companies come together, they actually grow slower than they used as individual companies, have lower margins than individual companies. Synergy seems to be this promise that's made at the time of every acquisition, but delivering it seems to be really, really, really difficult. And we'll come back and talk about what might cause that. But synergy doesn't show up in practice. And finally, when you track acquisitions, half of all acquisitions get reversed within 10 years of the deal, which is the ultimate admission of it things didn't work out. So a company gets bought with a lot of fanfare with a big premium, and 6 years later, 7 years later, it gets sold off for a third or a quarter of the price you paid up. So the bottom line is whether you look on the day of the acquisition in the market judgment or in the follow through, it looks like most mergers don't deliver on the promise that's made at the time of the deal. Now, in case you're wondering whether this is a US-centric phenomenon, the disease is spreading globally. Explain, until about 20 or 30 years ago, if you're an emerging market company, an Indian company, a Chinese company, a Brazilian company, you were usually the target of an acquisition. Why? Because a US or a European company would come in and acquire you because their market cap is much bigger than yours. For a long time, Indian companies were targets. Starting about 3 decades ago, Indian companies started to acquire enough market cap, enough heft, that they were acquiring US or European companies. And from a nationalistic perspective, Indian Business Magazine celebrated the fact that Indian companies were now big enough to acquire US companies or European companies. But be careful what you wish for because it comes with consequences. This is actually a study that looked at Indian companies acquiring US targets in the months around the acquisition. So there's month 0. They go out and do the acquisition. Initially, things go well, stock prices continue to rise. So this is a cumulative return. So basically, it's stock prices building up over time. They peak about 3 months after the deal. And then reality seems to set in. And if you keep tracking them, by the time you get to 20 months after the deal, not only have you given up whatever rise you had at the time of the acquisition, you have essentially gone well below where you were before the acquisition. This is not just a US issue. This seems to be an issue with acquisitions in general. In fact, if I were to summarize all of the literature in acquisitions, and as I said, there are hundreds and hundreds of studies, here's what comes through. If companies try to grow through acquisitions, it seems to be much more difficult to create value than growing with internal value. Not impossible, much more difficult. In general, acquiring firms pay too much for target companies. Again, there are exceptions. Clearly, there are companies that get bargains, but in general, they pay too much. They overestimate the value of both synergy and control. We'll come back and put some real numbers on both of those, and have a really difficult time delivering on promised things. But here's why it's even more troubling. The first studies that showed that acquisitions did not work came out in the 1980s. And in the 1990s, each decade, you have more studies. You'd think you'd learn from this, right? But if you look at acquisitions, people don't seem to be learning any lessons from all of these studies. They seem to be repeating the same mistakes over and over again, which makes no sense. If you have a process that's screwed up, and you're getting results that show the process is not delivering benefits, you think over time people would learn and adapt. It doesn't seem to be happening in the M&A process, which leads me to conclude that there's something systematically wrong with this process. Something that makes it difficult or even impossible to bring the learning in. One of the things we talked about is the nature of the process, which is that deal makers want the deal to go through. The bankers in the room want the deal to go through. And to the extent that they drive the decision making, you can't blame the bankers. The CEOs of the acquiring and target company must be willing collaborators in this process. that they are willing to get this deal through. So we'll come back and talk about the bias in the process, but it plays out in the way people assess valuation. I think there's more, more damage done to valuation first principles in the M&A process than any other process that you see valuation. So what I'd like to do today is actually talk about 7 things I see happening now in the M&A process that systematically get in the way of assessing value right and paying the right price. Now, the history of this part of the class came about 25 years ago. Student of mine runs these seminars, executive seminars in New York. So one summer he calls me and he says, I'm running a seminar for CFOs of companies, but these are a special group of companies. And he described them, and for lack of a better term, I'll call them serial acquirers. They're companies that go out and do acquisition after acquisition. So these CFOs of companies that did acquisitions. And he said, can you come in and talk to them? And I said, do you really want me to come and talk to them? You know what I think about acquisitions, right? He said, I know exactly what you think about acquisitions, but they're going to be listening to bankers for the rest of the day and consultants. And you know what they think about acquisitions, the mother's milk for all deal fees. I'd like you to come in and talk in the last 30 or 45 minutes and provide some counterweight. I showed up, I put the first slide up, and you can see the first slide kind of gives away my view of acquisitions. I think of acquisitions as an addiction. The reason I call them an addiction is when a company starts to grow through acquisitions, it becomes very difficult to go back to organic growth because it's so much more work, right? Taking 100 projects as opposed to one big deal. You can do it quickly. You get a lot of ego boosts along the way. Your name's in the paper. It's an addiction, and every addiction needs drug dealers kind of feeding the addiction. And the M&A process is a lot of dealers, consultants, bankers. Look at how much of BCG and McKinsey is built around selling the notion that acquisitions can work, in spite of all the evidence to the contrary. So let's talk about doing acquisitions right. And part of that is essentially going through and making sure you don't make these mistakes. So I'm going to list out, and this is part of what I sent you in advance. In the series, a very simple test. It'd be a good way to review basically all evaluation as we go through and understand the M&A process. I'm going to start by talking about what I call risk transfers. Basically, we're acquiring companies, think they can endow target companies with their risk characteristics. And we'll see how this plays out in discount rates and valuation. Second, I want to talk about debt subsidies. An acquiring company is able to raise money at a really low rate. And I think because it can raise money at a really low rate, it can pay a higher price on an acquisition. How dangerous this is if you actually follow through. Third, I want to come back and look at control. I started this class by using control as one of those weapons of mass distraction. And I think I mentioned the number 20%. Bankers have used this 20% control premium for as long as I remember in M&A. I'm going to argue that there can be a value of control, but it's definitely not 20% for every company. We'll talk about actually putting a number on the value of control and why it can be high for some companies and low for others. Then I want to talk about synergy. It's true there can be synergy. In fact, I'm going to argue that synergy defined right is actually a very narrow set of circumstances that people use synergy to think that they shouldn't be bringing in. So we're going to start by defining synergy and look at how to value it in its different forms. First, I want to talk about how pricing enters the game. When we talk about intrinsic value versus pricing, often when you do acquisitions, you have to pay a market price. This has nothing to do with intrinsic value. We'll see how pricing plays out in acquisition and how pricing is misused, because we talked about using data and using it well and controlling for differences. We talk about the way biased samples and bad controls can lead to bad pricing. Sixth, and I think this is a huge issue. In acquisitions, people decide what to do and then they go looking for justification. This is the biased part of the process. They don't want the truth. They basically want confirmation of a decision they've already made. And finally, I want to talk about the fact that there seems to be absolutely no accountability in this process. What I mean by that, is you take a bad project, a $15 million bad project, you get fired. You do a $15 billion acquisition, you overpay by 50%, you get promoted. Something screwed up about this process that means that if you do bad deals, nobody seems to be held responsible for those bad deals. So and as I go through, here's what I'd like you to do, and I'd like you to be honest with yourself in each of these tests. So I'm going to put very simple tests, and I'm going to ask you questions. And if you pass the test, put a check against passing the test. And if you fail the test, put a fail on it. And if you fail more than 2 out of the 7 tests, please, please, please don't go to work again. You'll pass all more than 5. Don't worry, you can keep your job. I'm not going to be so basically that's what I want you to do. But it's going to be very simple tests. I want you to try as we go along. Good. So let's start with the first test. You have an acquiring company with target. You're working for the acquiring company. Target company has $100 million in revenues, 80 million in operating expenses, gives me operating income of 20 million. Pays taxes of 8 million, has after-tax operating income of 12 million. And I'm going to make this a very simple valuation. You don't need to bring out your calculator. This company is going to earn $12 million every year in perpetuity, 0 growth, and has a cost of equity of 20%. How much? It's an all equity funded company. How much is the value of the equity / company? Right now, we know enough valuation to answer it. Looks like I haven't given you enough information, right? I haven't given you CapEx, I haven't given you depreciation, I haven't given you working capital. Why don't you need it? What does the no growth imply? You have no growth, you don't need any reinvestment, which means your after-tax operating income becomes your cash flow. So the $12 million in after-tax operating income becomes $12 million in cash flow. The perpetuity, 20% discount rate. So the value is 12 divided by 0.2, which is 16, I think. Don't worry, that wasn't part of the test because you all failed. That was part of it. So 60 million is your base number. Now comes the first test. I'm the acquiring company. My cost of equity is only 10%. What is the value of the target company that I just showed you? With 60 million without having any looked at it based on cost of equity. What is the value to me as an acquiring? You see, basic question I'm asking you, right? When I'm an acquiring company valuing a target company, should I be using the target company's cost of equity or the acquiring company? This is the Kennecott. Remember the Kennecott, the start of the class test we did where first cost and used the wrong bit. So it should be the, what did you say? That company, 20%. The target company's cost of equity, not the acquiring company's cost of equity. And this already half of all mergers. In half of all mergers, the acquiring company's cost of equity / capital is used to value the target company. And if you've done that, you've already fallen the very first step. So you're going to run into this in practice. So when you have somebody on the other side of the table saying, but we're raising the money, the acquiring company, why should we use our cost of capital? Explain to me in very simple intuitive terms why I should be using the target company's cost of equity to value the target company. Why shouldn't I use the acquiring? I'm going to put it on you because you're going to run into this. Yeah. Why shouldn't you use the acquiring company's cost of equity?
I think the business doesn't change because you are the one acquiring it. So since it's as risky as it was before, the acquisition is going to drive your cost of equity up, and it's not going to be 20, but it's not going to be 10.
Remember last session we talked about Biogen having this drug that they get licensing fees from the government. And what do we use as a discount rate when you get the licensing fees from the US government? We use the risk-free rate. Then when they had the licensing fee from a pharmaceutical company, we use the cost of debt. You see where I'm going? The discount rate for a cash flow has nothing to do with the entity looking at that investment. It's got everything to do with the risk of the cash flows. It's a basic capital budgeting precept. The discount rate for projects reflect the risk of the project, not the risk of the entity looking at the project. So as an acquirer, if you go out and you pay, the 100, in this case, but I'm sorry, if you had used the 10% cost of equity and I paid the 120 million, I am paying 60 million for absolutely nothing. It's not like that, those cash flows are going to become safer because I have. Already you can see why companies which are mature companies often end up overpaying for young growth companies. But here's what they do. Now, if I am, IBM and I buy Twitter and I use IBM's cost of equity to value Twitter, of course Twitter is going to look cheap to me because I'm using the wrong discount. So that's the first step. Make sure that when you look at target company valuations, using the target company's characteristics, its risk profile, to come up with the cost of equity for the target company. But let me ask a little more subtle question about finance. Let's say so the rule is very simple. Risky businesses don't become safer when you acquire them. Use the risky businesses cost of equity. What if the reverse is true? What if you're a risky company buying a safe company? First principles are still first principles. Don't try to be conservative and say, I didn't say the higher of the two discount rates. I said the discount rates reflect the risk of the cash flows. If you're a risky company buying a safe company, the same principle applies. You use the target company's cost of equity to value the target company. Always. No exceptions, none. You see, what about the fact that my cost of equity is going to be a weight? After the fact, the combined company is going to have some weighted average, but that's completely irrelevant to making this particular valuation and this particular decision. Now, this gets a little trickier. Let's suppose I, as the acquiring company, have a really good rate. I'm rated AA or AA plus, and I can borrow money at 4%. And I plan to fund this project with 50% debt. Why? Because I have debt capacity. I am under-levered. I can go out to borrow money. So here's what I plan to do on this acquisition. I plan to raise half the money from equity and half the money from debt. For purpose of simplicity, let's assume the cost of equity stays at 20%. It should actually go up, but let's say it stays at 20%. And I'm now raising half of the money from debt. And I'm borrowing money at 4%. What's the value of the target company? If you're mechanical, what do? You compute the cost of capital, right? You put 50-50 weights. You put 4% as your cost of debt after taxes and 20% as your cost of equity. You're going to end up with a 12% cost of capital. You're going to come up with a value of 100 million for the target company. In other words, you're paying a $40 million premium. You say, what's wrong with that? Why are you paying the premium again? Because you have a really low cost of debt and you have excess debt capacity as the acquiring company. So why are you paying the premium to the target company shareholders? They had nothing to do with this. Render unto the target company that which is theirs and not a cent more. In this case, by paying that premium, you're effectively transferring wealth from your company, which has earned this right to have a low cost of debt and excess debt capacity, to the target company. We talk about what if the target company could have borrowed money on its own. That's a different question. They've chosen not to, then it's a different question. But if you as the acquiring company are borrowing money because you have debt capacity, and if you really low cost of debt, be very careful about the mechanics of cost of capital. So you're not careful, you're going to end up subsidizing the target company for something that they had no role in doing. So what I'm trying to say in indirect ways, do not compute cost and capital for target companies based on the actual funding mix that is used in the acquisition, because it might have nothing to do with the target company. I've actually seen people value target companies with the acquiring company's cost of debt. You know, under what conditions? Because often acquiring companies that are big enough might borrow the entire amount to buy a target company. So somebody who's purely mechanical says this company is being funded 100% with debt. It's all acquiring companies' debt. Their after-tax cost of debt is 4%. Imagine how high the value is going to be for the target company if you do that. So be careful not to use the funding mix from the acquisition to come up with the cost of capital. Let's talk about true control and this 20% control. If you look at the, and many acquisitions, one of the reasons that's given for doing an acquisition is the value of control. In fact, I heard somebody use it in the context of Musk acquiring Twitter, that he's buying the company for the value of control. which might be a good description of what he's planning to do. But when you look at how control is actually assessed or priced in acquisitions, bankers value target companies and add 20% onto that value. Pretty much on every acquisition thing, that's a value control. So let's step back and think about what the true value control is. If you think about my example where the target company that I showed you, the operating margins are 20%, the operating income is 20%. Let's say that you believe that this company is badly managed and badly run. You believe that if you ran the company, you could cut costs and improve margins to 30%. What's the value of this company to you, at least as a ceiling? Assume the growth stays zero and the cost of equity stays 20%. The value go from 60 million to 90 million, right? 18 million divided by 0.2 would be 90 million. So the value control then would be the $30 million difference between the 90 and the 60, but think of where it's coming from. It's coming from the fact that you can run the company better than the existing. But before you pay the 90 million, remember who's doing the hard work of cutting costs and improving margins? It's you as the acquiring company. If you pay the entire 90 million up to the target company, you're essentially paying them the premium for running the company much better, but you're claiming none of it for yourself. So as you're valuing the target company, remember, you got to keep some of that for your shareholders, otherwise what's the point? So when you think about the value control, it's not 20%. It's a function of how well or badly run a company is. And at the limit, if you have a company that's already perfectly managed and perfectly run, I can't think of a single company that actually reaches that degree of perfection, but if it is, the value of control will actually be zero. So think of the value of control as a continuum. It could be close to 0% for a really well-run firm. It could be 100% or more for a badly run firm, depending on how much change you can bring in. So watch out for rules of thumb. M&A is full of rules of thumb. Control premium 20% is only one of them. And when you see these premiums for all kinds of things, great management, those buzzwords that we talked about, you see all those buzzwords get. Many of these premiums, we ask people where do they come from, they'll claim it comes from data. But I'll tell you where the 20% premium comes from. It comes from the service called merger stat. It's been around a long time. It's not a sophisticated service. All it does is collect data on every single acquisition. It lists the price before the acquisition, it lists the acquisition price, it lists the premium on every single acquisition. You know what these studies do, right? They take all the acquisitions, they take the average premium paid over the market price before the acquisition was announced, and that average is around 20%. But even if that number is right, so a couple of follow-up questions. Why do you call that a control premium? What else do people pay in excess amount for? There's synergy, there's stupidity, right? If you overpay, where does it go? In other words, that 20% could be a stupidity premium, a synergy premium, a control premium. To attach everything to control suggests to me that you're ignoring the fact that companies sometimes overpay. It's a stupidity issue, or synergy is even an issue. If you're presented with the data, push back. Ask them, ask yourself, or ask the person pushing the data, what is that premium for? Why is it always for control? Which brings me to synergy. I'll give you my definition of synergy. You're already going to see why when people talk about synergy, sometimes it is categorized. The essence of synergy is two companies come together and they're able to do something they could not have done as standalone companies. Let me repeat that again. Two companies come together, they're able to do something they could not have done as standalone companies. So if you're a badly run company, you think you can be run better, that's not synergy, that's control. Because you can fix that yourself. But if you're a US company buying an Indian company because it'll allow you to grow in the Indian market and the Indian company can grow in the US market, that's synergy because you need the combined company to be able to do it. That is the test you need to run. The next time somebody talks about synergy and they say this, go through the line items because I'll wager half or more of the line items really not synergy. It got to do with control and running the company better. Synergy is specific about two companies coming together. They're able to do things they could not have done as standalone companies. So can there be value to synergy? Absolutely. It can come from lots of different things, right? Two companies can come together and may be able to cut costs, economies of scale. When you have horizontal mergers of companies in the same business, if JetBlue was trying to acquire Spirit Airlines, I think Spirit's trying to fight it off. You could argue that the savings are not going to come from higher growth, they're going to come from lower costs. Because you got overlap and distribution, whatever, aircraft. It could come from higher growth in some cases. But I'm going to list out all the possible ways to get synergy, but the key is in all of them, I'm looking for a combined company being able to do things that they could not have done as standalone. And after I've done that, I've come up with a number for the synergy. Again, as an acquiring company, I'm not giving you license to go out and pay that as a premium, because if you pay the entire synergy as a premium, guess who's walking away with the winner? Target company shareholders. Again, at every step of the way, as an acquiring company, you value control, you value synergy. The question you're asking is, how much of that can I fight for my shareholders? Because they're the ones supplying the capital, they're doing the hard work. So let's list out all the ways in which synergy can show up in mergers. Broadly speaking, when you look at synergy in mergers, it can be either operating synergy or financial synergy. Let's start with operating synergy. Operating synergy, the simplest and most straightforward operating synergy is economies of scale. I gave you the example of two airlines coming together. They're able to cut costs because they have overlap. That's economies of scale. Easiest to deal with because economies of scale show up as lower costs, higher margins, higher value, you're done. With every one of these synergies, that's going to be my intention. You tell me the synergy, I'm going to look for the number and valuation I can move to reflect. So that's the easiest synergy. You can have growth synergies, and growth synergies can take multiple forms. It can be that you can earn higher returns on any new investments you take from now on. You earn a higher return on capital, you get a higher growth rate and a higher value. It could be that you can take more new investments by coming together as a combined company. So company A could take 5 projects and company B could take 3 projects. If you combine them, maybe they can take 12 projects instead of the 8 they would have taken as individual companies. Often near cross-border acquisitions, that's what's driving it. The combined company, we might be able to take more projects. More projects translate to a higher reinvestment rate and a higher growth rate. It could be that you earn higher excess returns. Why? Because your competitive barriers to entry become stronger as a combined company. Maybe your 2 companies put together are much stronger against the competition. Shows up as a higher excess return, and higher excess returns translate the same growth rate into a higher value. You've got cost savings, you've got growth synergies. Growth synergies are always more difficult to value than cost savings, but they do it. Those are operating synergies. I'd love to tell you that most synergies in mergers come from operating savings, but they don't. This is a cynical view of the word, but a significant portion of the synergy that shows up in acquisition has nothing to do with lower costs or higher margins. I'll tell you, one of the most common reasons for mergers is a reason that should never be talked about, even if it's the main reason. You know what I'm talking about? Taxes. 2 companies coming together pay less in taxes than the 2 companies were individual. I'll give you the reasons it can happen. One is if you're able to write up the book value of your assets at the time of an acquisition. In some countries you're allowed to. What that allows you to do then is get higher depreciation of the same assets, greater tax savings. You have a money-losing company taking over a money-making company taking over a money-losing company, or vice versa. The combined company is going to pay less in taxes than the 2 companies that are individual. Why? Because the money-losing company would have paid no taxes. The money-making company might have paid 40%, but by combining the 2 companies, you save in taxes. There are some countries where the tax law specifically gives you benefits if you do acquisitions. I'll give you 2 examples. For the longest time in the EU, Spain used to allow impairment or writing off of goodwill, amortization of goodwill to be a tax deductible expense. That's not allowed in most of the world. In fact, in the US, when you see an impairment of goodwill, it's a complete non-event when it comes to tax. But Spain has this special add-on to the tax law that if you had goodwill that you amortize, you can claim it as a tax deduction. Now, whenever you do an acquisition, you're going to create gigantic amounts of goodwill because you're paying more than the book value. It's almost like they're letting you depreciate market value by doing that. That's going to mean that when you do a merger in Spain, you get tax benefits in the combined company. in Brazil, there's an item called interest on capital. It's a very unusual item. Brazil is the only country that I know of that allows you to do it. And it comes from this well-intentioned desire to make equity have the same kinds of tax advantages. You know, when you borrow money, interest is tax deductible, right? So I don't know when the Brazilian government decided to do this, but they decided that if you had book equity, they would take a percentage of book equity, and they'd specify each year, they'd specify, this year, for instance, might be 12%. You could take 12% of book equity, it's called interest on capital, and claim it as a tax deduction. You think, so what? When you do acquisitions, one of the things that happens, your book equity goes up. Because you're combining two firms, you're paying the market value for another firm, it now becomes part of your book equity. So your interest on capital jumps significantly after the merger. When Ambev was acquired by InBev, InBev was a Belgian brewer, but Ambev at that point was a Brazilian Bev brewer. When InBev bought Ambev, it is estimated that half or more of the synergy from that merger came from the interest on capital line item. But as I said, if this is the reason for a merger, for God's sakes, never mention. Because you know what happens when you say, we're going to do a merger driven primarily for tax reasons, right? Because that's like waving the red flag for the tax guy saying, come and get it. And they will. Like when Pfizer was trying to do an acquisition of this, I think, Irish pharmaceutical company or UK, it was going to be an inversion pre-2017. One of the things US companies used to do to reduce taxes is at that time, US law, US was one of 6 countries that actually taxed companies with global income, which meant that you made income anywhere in the world, they made you pay the differential tax between the US tax rate and that country's tax rate. So if you made income in Hong Kong and your tax rate was 50%, at that time the US tax rate was 40%, they made you pay the extra tax on the 25%. So what US companies wanted to do is they wanted to become UK companies, which would have that issue. So here's what Pfizer was planning to do. It was planning to buy Allergan. And after the merger, remember you create a consolidated company, you can decide which country you're going to. So they want to do this merger and then overnight after the acquisition, even though Pfizer was a bigger company, become a UK company. It's not pure. I mean, this was an entirely tax-driven transaction. So the CEO of Pfizer was on CNBC the day after this. And I expected him to use all the buzzwords, like strategic reasons, use all the S words, were synergies. And he came out and he said, well, primarily, we think we can save on taxes. You know, I almost hit my head against the wall there. Because right out, the minute he said that, you could see everybody waking up. And days after that, it became part of what the Senate was talking about, the IRS crackdown, the merger had to be put, they couldn't go through because they made taxes front and center. But the reality is, taxes are very much part of the story. It could be that by combining 2 firms, you increase your capacity to borrow money. Makes sense. Let's suppose your company A and company B, and given their existing cash flows, each can borrow 20%. That's their optimal debt ratio, and they're at 20%. You combine the 2 companies. Remember what we did last session with options? You create a safer company. It's not just a bigger company, but these two companies might move in different directions. Your debt ratio can now become 30% or 20%. That extra debt capacity pushes down your cost of capital, increases value, another potential synergy. And there's diversification. When a publicly traded company says, I'm going to do an acquisition, or we're going to do an acquisition to become a more diversified company, the response should be, don't do it, because your shareholders can do it without paying a premium. So publicly traded companies, that rationale doesn't work. But remember when we valued private companies, we had that total beta concept. Anybody want to remind me what a total beta is? You take the market beta and you divide by the correlation of the company with the market, right? Let's say you have company A, a private company, acquire company B, another private company. After the acquisition, you become one company. Guess what's going to happen to the correlation of the combined company with the market? Generally, it's going to go up. In fact, if you create a conglomerate, private conglomerate, you might very well create something like a mutual fund with a correlation close to 1. If you ever wondered why family groups in Asia and Latin America end up being in every conceivable business, you get a chance. In India, go look at the Tatas, they're in every single business. They did it because until about 30 years ago, they were privately owned businesses, and this was their way of reducing that lack of diversification effect that pushed up their cost of living. So the two private businesses coming together, synergy can actually take the form of a lower total value because you now have a higher correlation. The bottom line is you tell me where the synergy comes from, I should be able to trace out the effects of synergy and value the synergy. So the question is, can synergy be valued? Absolutely. But to value synergy, what do I need? I need specifics. I can't just have buzzwords, I need specifics. So I'll go through the three-step process you can use to value synergy. First step, value the two companies standing alone. You can never value synergy by just valuing the target company. In fact, the dead giveaway that a banker is not valuing synergy if they show you just the valuation of a target company. You need to value the acquiring company. You need to value the target company as standalone companies. Step two, just add those two numbers together. Value is additive. If there were no synergy, the combined firm's value should just be the sum of the acquiring and the target company value. That's step two. In step three, take the combined firm and put in every synergy benefit that the company talks about. Lower cost, higher growth, lower cost of capital, put them all in. In step three, value the combined company with the synergy benefit. You see what that's going to allow you to do, right? What you get in step three, if you net out what you got in step two, which is the value of the two standalone companies, that difference will be the value of synergy. So let's try this out. It's about 20 years ago. Procter & Gamble, at that time, the largest consumer product company in the world, bought Gillette, I think the fifth largest consumer product company in the world. And talk of synergy filled the air. That's all they talked about. So I decided to try to value synergy in this deal. So remember the process. First, I valued Procter & Gamble standing alone, 221 billion. So this is basically a DCF valuation of Procter & Gamble. Second, I valued Gillette standing alone. I came up with about 60 billion. Let me pause right there. If there were no synergy on this deal and these two companies came together, what will the value of the combined company be? It'll just be 221 plus 60, 281 billion. So file that away, that would have been the value of the company with no synergy. Then I created the combined company. They actually didn't call themselves Piglet. I thought P&G and Gillette, that would be a neat name. Now, but whatever the new name is, you take the combined company, and I did a best case valuation of synergy. Let me explain why I call it the best case valuation. I took everything managers said they were going to do after the merger and assumed they would do it instantaneously. So they talked about cutting costs by 250 million. I assumed they meant everything they said, that they would cut costs by 250 million starting tomorrow. You know why that's best case, right? Most companies, you have two companies come together and they talk about cutting costs. It takes a while to play out. Here I'm assuming it happens overnight. What does that do? It pushes down the operating expenses, pushes up the operating income. They did talk about slightly higher growth, that Gillette was not utilizing its brand name as well as they thought they could. They thought they could bring the Procter & Gamble marketing muscle to Gillette by getting a slightly higher growth. Lower cost, higher growth rate. I value the combined company with just those two changes put in. The value that I got was 298.4. My best case scenario, the value of synergy is 17.2 billion. There's this canard that in finance, we think synergy is worth nothing. That's not true. In this case, clearly, synergy is worth a lot. You think this must have been a good merger, right? What have I not told you that will tell you whether this was a good deal or a bad deal for Gillette, for Procter & Gamble? There's a lot of synergy, that's good. But what's the final piece of information you need to judge this merger from the perspective of Procter & Gamble shareholders? How much they actually paid? How much they paid? They paid a $25 billion premium. And now we wonder why M&A doesn't work for acquiring company shareholders. Because you take a best case valuation of 17 billion, you pay 25 billion, that's like taking a negative net present value project of minus 8 billion. It's not because the deal is not a good deal and the fit is not good. They're all there. You just paid too much. At the risk of oversimplifying acquisitions, I make a statement that drives M&A people crazy. At the right price, I will buy any company. At the wrong price, you can give me the best fit company in the world and I'm not going to buy it. It's about the price that's going to determine whether a deal is good or not. But
So are you suggesting that the acquirer should never pay a premium for synergy?
no, that's not what I'm saying, because the premium here will be based on the market price. So let's say market price is 60 billion. You can still pay a synergy up to 17 billion and get away with the deal being a good deal, right?
Or you're just giving that value up to the target?
If you pay the entire 17 billion. So if you're a canny acquiring company management, you know what you're going to do, right? You're going to pay a premium, but you stop at a $10 billion premium.
So how is that decision made?
I'm sorry?
How is that decision made?
That decision is made when you're sitting at the bargaining table. And here's the problem. To do that, you've got to be willing to do what? To be willing to get up from the table and walk out if the price gets too high, right? That's where I think acquisitions go wrong. Because when I send you into that room, what do I define as success? That you come out with a deal that's done, right? You come out and say, I'm not doing the deal. You're probably going to be fired because you didn't do your job. And this is, I think, why acquisitions get into trouble. Is we've defined success as getting deals done. I gave the example, I think, very early on of Bruce Wasserstein and Joe Perella. And Bruce Wasserstein, it's called Bid 'em Up Bruce. And he very clearly said, my job in an M&A, if I'm called in as a bank in M&A, is to get the deal done. And I remember in one of his interviews, he asked, do you worry about the deal being a good deal or a bad deal? He said, my job is to get the deal done first and worry about whether it's a good deal or a bad deal afterwards. Which my response is, what's worrying about it afterwards going to do? You're going to send a bill to the target company shareholder saying, we overpaid, can you please send back $20 per share? But that's, I think, part of the problem is if you negotiate and you're unwilling to walk away from the table, you've lost all bargaining power because the other side of the table, they know you're going to pay any price to get the deal done. And they're going to keep pushing. Not just the 17 billion, but through because they know you want to get the deal done. Yes.
Quick follow-up, wouldn't the amount that you're willing to pay involve in valuing the target as compared to other people that can be acquiring it? Is that?
Why does it matter? Bad deal. The fact that other people are willing to make even worse deals shouldn't be a justification for you doing a bad deal, right? That's the defensive acquisition argument, which is if we don't do it, one of our competitors go, let them bury themselves by paying too much in acquisition. But I hear that all the time from CEOs. Is we don't do it, our competitor will do it. Let them do it. Nothing destroys a company sooner than overpaying on a deal. In fact, I'm going to show you a graph of what happens to in bidding wars, what happens to winners and losers in bidding wars. And you're probably not going to be surprised as who comes out the ultimate winner when you have a bidding war and you actually end up losing that transaction. Let's take a second example, tax benefits. Again, I'm going to make this very simplistic. Let's assume that you work for Best Buy, an electronic retailer. And you're buying Zenith. At one point in time, a legendary TV maker in the US, but now it's a shell of a company. Only get basic. Let's strip things down. Let's suppose there are no operating assets left in the company. Nobody buys a Zenith anymore, but they're one big asset. A net operating loss of $2 billion. That's all you want. To your Best Buy, your tax rate is 36%. If when you bid for Zenith, how much is the tax benefit worth to you, given those two pieces of paper? You can claim the tax benefit immediately. It's going to be 36% of 2 billion, which is 729, right? But that assumes you have enough taxable income to cover the entire 2 billion. So let's make this a little more interesting. Let's assume you have only $500 million in taxable income. You got a $2 billion NOL. Let's assume that income is 500 million every year for the next 4 years. So instead of getting 720 million right now, you're going to get 180 million every year for the next 4 years. Do you see why it's 180 million? First year you claim the 500 million. So each year you're breaking out a $500 million NOL. So you have a $180 million tax benefit every year for the next 4 years. How much do you pay for that? The present value of 180 million every year for the next 4 years. So I'm going to ask you kind of the question that I think you can reason your way to. What discount rate should I use on that $180 million expected tax benefit? What's the risk that I will not get? What's the thing? I know they know what, right? There's no uncertainty about it.
I think the risk is more now on the acquirer.
It's basically on the taxable income. But you see how the reason, so there's no one answer that's going to work every single time, because you've got to go back and say, where is the risk coming from? And the risk here comes from the fact that the taxable income at Best Buy, the expected values are $500 million, but it could be 300 million, it can be 300 million, it can be 700 million. So if you take from that, should I use cost of equity or cost of capital?
I think cost of capital.
Taxable, yeah, right? Which is after interest expenses. Remember, you need enough tax. So it's actually the right answer here. So you can get away using the cost of capital. It's the cost of equity of Best Buy, because the risk here is the taxable income moving up and down. So what I'd like you to do is every time you get stuck on what discount rate should I use, go back to where is my uncertainty. So that's always going to give you a guidepost to which discount rate you should end up. So there's a lesson that comes out of this is synergy might be a great sounding buzzword, but don't pay for buzzwords. If there's synergy, it's your job, it's your obligation to value the synergy. And it's also your obligation to try to negotiate to get some of that synergy value for your shareholders. They're doing the dirty work, they're doing the heavy lifting. They deserve to get some of the benefits. Remember, by definition, you need both firms for the synergy. So why give away 100, in this case, 150% of the synergy to the target company if you're the necessary part of making this work? I don't know whether Microsoft actually valued synergy at Activision. I seriously doubt that they did, because the fact that they kept using metaverse as their constant explanation suggests to me that they were, I don't even know what that means. What does it mean in terms of Microsoft's revenue and operating income? But he said, this is my entree into the metaverse. But if you're going to pay for synergy, you have an obligation to value it and try to negotiate for a piece of it for your shareholders. Which brings me to pricing. If you ever taken an M&A class and you look at pricing, pricing in M&A takes on this very specific set of a peer group. It's called transaction multiples. So what you often do is you look at other companies that have been acquired, if you can, in the same sector, and you look at what people paid on those acquisitions, as opposed to what? In typical pricing, you look at all companies in a group, but in transaction multiples, you look at only the subset of companies that have been acquired by the people. So what you do is you take those transactions as acquirers, and you said, let's say that they typically paid 5 times average to acquire companies. Remember the target company I showed you, the EBIT of 20 million. 5 times 20 million is 100 million. So since none of my DCF arguments working on you, I've given up on them, and I said, you know what? We will expect these 100 million for this company, because that's what other acquirers are paying target companies. The pricing, right? There's nothing wrong with pricing. After all, acquisitions are pricing game. But what am I doing wrong in this pricing? To make it all about the price, what is it about the process by which I'm pricing this company that should give you trouble? I have a sample. I'm using a sample, right? But what's the first rule in statistics? The sample should not be a biased sample. By using transaction multiples, do you see how I'm introducing bias? I'm looking at a subset of companies that people have acquired, and by definition, those companies are going to be companies where you paid a premium on the price. So rather than pricing companies, I'm pricing the company with the premium already built in. It's almost circular logic, which is I'm going to be able to explain away a 20% premium because everybody else is paying. And pushing it off into the terminal value doesn't make this problem less, because sometimes bankers do that. Rather than use it on today's EBIT, they will use it on the EBIT in year 1. So there's nothing wrong with pricing, but if you're going to do pricing, at least do it right. Don't use biased samples. And if you're using an EBIT multiple, I'm curious, why don't you use a book value multiple? Why not an invested capital multiple? Why not a revenue multiple? Push back. Because if you let me pick the multiple, I'm going to find the multiple that best justifies whatever I'm trying to get you. So if you're the acquirer, it's your job to push back when bankers use multiples and say, hey, that might be the multiple you think works, but what if I use this multiple instead? You're still staying in the pricing game, but you want to see how sensitive your pricing is to the multiple choice. But I'm going to hit you with a word that in many cases is what pushes acquirers to actually go through the acquisition. I tell you that this deal is going to be an accretive deal. As opposed to what? So explain to me what it means when I say deal is accretive. What does it mean? What are the mechanics that lead to this?
I think the earnings per share is increasing after the acquisition.
So if you look at the combined firms' earnings per share, it will go up after this. So the acquiring firm is an earnings per share by the target firm. After I do the acquisition, my earnings per share as an acquiring firm will go up. Kind of a strange definition of a good deal, right? Because in terms of mechanics, you know when your earnings when a deal is going to be accretive, when a low PE ratio company buys a high PE ratio company, it's always going to be diluted. When a high PE ratio company buys a low PE ratio company, the deal is always going to be accretive. It's almost just a math, right? So you're telling me that anytime I buy a company with a lower PE ratio than mine, it's automatically a good deal? That doesn't make sense. I think the word accretive and words accretive and dilutive should be retired from the M&A term. They're extraordinarily dangerous because people often use them, but they really mean absolutely nothing about the quality of the deal. You can have a dilutive deal that's incredibly value creating and an accretive deal that's value destroying. In fact, McKinsey did a study of deals broken down into accretive and dilutive, and they found the dilutive deals actually added more value than the accretive deals if you track them down. So you hear this word thrown around, but clearly there's really nothing much you would learn by looking at accretive and dilutive. So first, if you're going to price a target company, do a transaction model. Just take all the companies, just do what you did in regular pricing. If you then want to add a premium on that pricing, look for synergy or other reasons to do it. But don't let transaction multiples determine how much you pay for a company, because you're then building in a premium that really has no justification. So that buyer sample part is, and the same thing applies, even if you do it as an exit one. So there's a lesson that comes out of all of this. It's just because everybody else is doing it, which is what pricing is, doesn't mean you should be doing it as well. If everybody's paying 20% premium for control, doesn't mean you should pay it as well. There's a lot of lemmingitis here when you use pricing and transactions, and your job is to push back on that lemmingitis. So now let's get to the core of why it's so difficult to walk away from that thing when the price starts to go above what you want. So think of, in any time you're going to winners curse an auction, well-established auction, that if you look at the winners of auctions, they tend to overpay. There's a very simple reason. You go to an auction, you start bidding on something, and you win. As you're celebrating, you should have mixed feelings about why you won. You won, so that's good news. But why did you win? Because everybody else in that room thought you were paying too much. Remember, that's the definition of winning in an auction. So you either know something that nobody else in the room does, or you just overpay. And the reality is, well, that might be the first reason, might be the reason in about 20% of the cases. In 80% of the cases, you tend to overpay. You get a winner's curse in auction. If you don't have a reservation price, you're going to end up overpaying if you want to get the deal. But here's the reason I think it's so difficult to walk away. Acquisitions, more than any other corporate action, come from the top down. No middle manager wakes up and says, let's do an acquisition. No, it's a CEO, probably in a dream in the night. Maybe an angel came to him in the middle of the night, said, go do an acquisition. He wakes up in the morning, he goes, we need to do an acquisition. Then it slows down the organization. And there's actually evidence that overconfident CEOs tend to do a lot of acquisitions. When you look at behavioral finance, one of the strongest and most dangerous qualities that drive bad decision making is overconfidence. And when you look at companies that are very aggressive acquirers, serial acquirers, many of them seem to be led by really overconfident people. So it shows up in a couple of things. One is when they look at a target company, they think they can do far more stuff with the target company than is realistic, and they overpay, saying, look, I can deliver all this stuff. So if there's overconfidence at its core, you're basically going to find that CEOs are going to find a way to justify almost any price. And because they can justify any price, there's pressure in everybody below them to get the deal done. Which means that if you really want your company to stop doing acquisitions, you know what you need to do, right? Get rid of your CEO. The CEOs drive this process, the top management drives this process. And of course, the argument they will often use is if we don't do what our competitors do. This is called defensive acquisition, where your argument is we can't afford not to do acquisitions. We know we're overpaid for cloud computing companies, but we don't do it for competitors. And I've never found that argument to be persuasive. Because history suggests that if you let your competitors keep overpaying, you actually benefit in the long term. In the short term, you might have to live through some pain. But I think that's, if that's the reason you're using, you've already lost the argument. So the lesson here is when you look at acquisitions and you look at what drives them, the key determinant seems to be the CEO's overconfidence. More than any other component seems to explain why some companies pay bigger premiums than others. And if your reason for doing acquisitions is purely defensive, that if you don't do it, somebody else will do it to you, you've already lost the script. So I'll give you an example of how there's no accountability in acquisition. About 15 years ago, HP, which has a history of terrible corporate governance through this entire century, the last 20 plus years, went out and acquired a UK-based software company, business software company called Autonomy. And they paid a big premium. They paid a huge premium, supposedly for synergy. So the time the deal was put together, they were paying a premium, they were paying about $11.1 billion for Autonomy. They explained how they did it. So when they did it, I actually broke down their explanations to see how they got $11.1 billion. So let's go step by step. The pre-deal book equity, I know book equity means very little, book equity of Autonomy was $2.1 billion. When Autonomy knew that they were going to be acquired, they called in Deloitte to reassess their book value. It's called, basically what accountants come in and they look at their existing assets and say, we've underestimated this, we could push up. That book value got pushed up to $4.6 billion. So the accountants magically added $2.6 billion to book value. The market value was $5.9 billion, which means the market actually had a $1.3 billion premium on what even the updated book value. HP paid $11.1 billion, which effectively meant they paid $5.2 billion for what they claimed would be synergy. The deal was done. It was one of those deals. It was unusual because most deals, when somebody pays for the deal, everybody else is reluctant to pass judgment because it might blow back. On this particular deal, when the deal was done, everybody was convinced that HP had paid too much. At that time, HP CEO was a guy called Leo Buck. Session, an equity research analyst conference here. He was in front of the analysts and one of them asked, are you paying this really hefty price for Autonomy? And everybody thinks you're paying too much. And he gave an explanation for why he thought it was a good deal. So I've highlighted exactly the word used because I don't want to be accused of misquoting. He said, we have a pretty rigorous process inside HP that we follow for all our acquisitions, which is a D.C.F based model. I don't think he has any idea what he was talking about, what a D is, but he's reading off a script, D.C.F based model. This is good, right? He's doing intrinsic valuation. He said, no. And we tried to take a very conservative view. So he's trying to say, look, we've lowballed the estimate. And then he should have stopped because he kept going. He said, just to make sure everybody understands, Autonomy will be on day one accretive to HP. That's the magic word. Just take it from us. We did this analysis at great length, in great detail, and we feel we paid a very fair price, and we're going to see great slipping in. It'll be nice if this will be the end of the story. 2 years later, autonomy fell apart. Well, HP's argument was the accountants lied to us. We didn't know how much deceptive stuff was in the books. But here's the problem HP faced. They had to write off the 11.1 billion down to 2.3 billion. They were writing off $8.8 billion the acquisition. And they just wrote it off. They said, we don't know what happened. The accountants lying to us. But I decided when they did this to start to assign blame. I said, okay, somebody screwed up here. $8.8 billion, this doesn't disappear into thin air. Let's see who to blame. First, I blame Leo Apothekar and the deal makers for overpaying on synergy. Clearly, they seem to have overpaid. Second, the accounting is cooked up. Somebody must have been doing the accounting. So I said, well, that was Deloitte, so let's blame them for that extra amount. If you go past that, the management running HP now, even though the CEO has changed, is still responsible because they couldn't even deliver the results that autonomy was delivering. My point is, deals have multiple parents when they're done. Everybody claims to have been on the deal. When deals fall apart, it's like an orphan. Nobody seems to have had any role. If I had my brothers, I'd go around, attach. So first I'd make the deal bankers pay back all their fees. They shouldn't have been getting fees in a deal like this. The CEOs, any compensation packages that are clawed back. And Deloitte should have been, responsible for at least a portion of this 8.3 billion that I'm writing. But you never see that happen. Not a single group ended up being held responsible for this tragedy. So that's a pretty bleak view of acquisition. Someone leave you with a glimmer of hope by making you make choices. So let's say you go to work for a company that decides it's going to grow through acquisitions, or you're consulting or advising a company and wants to grow through acquisitions. Let's see the process by which we can create a value-enhancing acquisition process. So I'm going to give you a bunch of choices, and I want you to tell me which one I should take if I want to create a company that grows through acquisitions and creates value along the way. You want to be a sole bidder on an acquisition or be in a bidding war? And if you're in a bidding war, do you want to be the winner or the loser of the bidding war? Let's see what the results look like. So, sole bidder. So that was the right choice. Public target or private target? Where do you think the chances of creating value are going after a public target or a private target?
Private.
And tell me why.
I think one of the things is the cost of capital.
What about the cost of capital? In a public target, what do I have to start with? I have to start with the market price and add a premium, right? The problem with the market price is it might reflect all kinds of stuff already, whereas with a private company, I estimate the value of the private company, I know what I brought in, and then I can add premiums, synergy and control. God knows what I'm paying a premium on, and I'm paying it on market price. So we're going to see what the results look like. You're going to be shocked at the divergence. Should you pay with cash or should you pay with stock? This is a tricky one. Cash. So you said cash? Somebody said cash? Yeah. Why cash?
Because I think the return that you make on the cash in hand would be lower than what you probably make by buying a company.
That's a really bad reason for doing a deal. You're going to be doing a lot of bad deals, right? Because cash is making a fair return right now. It's a low return, but a fair return, right? Remember, you judge returns based on the risk you're taking. So cash might risk in people's making 1%. That's a perfectly okay return.
But then would all cash acquisitions result in an accretive deal?
All cash acquisition.
Most of the cash acquisition, would they result in an accretive deal?
They will result in, they will create, they'll be accretive deals. That doesn't make them good deals, right? It'll just make it a riskier company. It'll be an accretive deal. Your earnings per share will be higher, but it'll now be a riskier company because you've gone from having a riskless investment. I mean, let's take an example. If Apple took its 200 billion in cash and bought this, is it good? It's true, the earnings per share for Apple after the acquisition will be high. But Apple will now be a much riskier company as well. The net effect on value, I can't tell until I've worked through the numbers. So there are reasons for using cash, but I don't think you want to use that one because that's a dangerous one. You'll be doing a lot of bad deals because of return. Yeah.
I was going to say it depends because if your earnings yield is super low, if you're a risky tech
right track, but rather than talk about earnings yield, if you think your stock is overpriced, you're going to feel the urge to use your shares, right? Because you're paying with a discounted currency. So if you're a high growth company and you think you're underpriced, even though your price earnings ratio might be high, you'd still be reluctant to use stock, but the degree to which you think your stock is underpriced, overpriced will play a role in whether you use stock or cash. Now, this is like game theory, and here's why it's game theory. You as an acquiring company choose to use stock, and I can see that as a target company. You know what I'm going to assume, right?
I think right.
That your stock is overpriced. So we're going to look at what happens to premiums, and you've got to be careful because the premium might get pushed up when you have a stock-based deal to more than offset whatever you benefit by using cheaper currency. Yes.
And I was just gonna ask that why sometimes when like the offer has a large proportion of stock off, that way it goes a little bit.
Yeah,
down.
and also because then you have two things to worry about, right? Because if I pay with stock, the stock price, let's say I paid for Twitter with Tesla stock, right? It's not happening. Then when I price the deal, the price is a moving target because Tesla stock price drops 15%, the price of the deal itself. So that's part of what you worry about as a target company shareholder, is you'd rather get the cash deal, you know exactly what it is. It's not a shifting target. You're not worried about people using overpriced stock. And it plays out as a lower premium on cash deals than on stock. The net effect though might still lead you to use stock. And how about synergy? Would you, how about would you not rather go for small targets or large targets? Small or large relative to your service company? Which way do you think the odds of success are great?
Small.
Small. In fact, history is full of big deals where two big companies come together. And then you write case studies about how terrible the culture war was in those two companies after they came together. And finally, we're going to have synergies. Would you rather have cost synergies or growth synergies? It's easier to plan for, easier to deliver than growth synergies. I'm not saying one is better than the other, but the history of delivery is much better on cost synergies. So let's back this up. Let's start with bidding wars. You know how bidding war works, right? One company in the middle, two companies are bidding for it. One of these companies is going to emerge as a winner on the deal, and the other is going to come out as a loser. The day the deal gets announced, the Wall Street Journal announces company A is the winner, company B is the loser. Winner being the one who won the deal. This is a graph. What happens to stock prices of the winner in a bidding war and a loser in a bidding war? You got two lines. Guess which one belongs to the winner? So this is the return. So if it drifts up, your stock is doing better than expected. If it drifts down, you're doing worse than expected. Which one do you think is the winner? That's a winning stock right there. So there's the win. You got the win. So at the time of the win, they're kind of at zero. If you track them in the weeks after, the winning stock ends up becoming the loser in terms of returns. So if you're a shareholder in a company gets involved in a bidding war, get down on your knees and open trade loses the bidding war. Because winning the bidding war will mean you get that media mention the next day as a winner, but then you see your stock prices drift down because you're overpaid. Small versus large. So basically what I've done here is taken acquisitions. The blue are deals which are less than, I'm sorry, that should be less than 5%, 5% relative to your value. So I'm looking at the target company as a percentage of the acquiring company. The reason is an $80 billion deal looks like a big deal, but if you're a $2 trillion company doing an $80 billion acquisition, like Microsoft did with acquisition, is like buying a company that's 4% of your market cap. So less than 5% means really small deals relative to yourself. More than 20%, so across the board, stock, combo, or you can see that bigger deals tend to do worse than smaller deals, with one exception. When you're doing an all cash deal, that might seem to be the only time when you're doing a big deal, a cash deal seems to beat out, a bigger deal seems to beat out a smaller deal. So you do a big deal and they're actually paid with cash, seems to be the only place where doing a cash deal comes out as a potential. But to me, this graph is perhaps the most interesting one. It compares what happens to your stock price when you buy public companies, private companies, and subsidiaries of public companies. You know what I mean by subsidiaries? A public company sells off a piece of itself. Now, across the board, the worst thing you can do is buying a public company, right? And every single potential way. So private company beats public company because you don't have market price price, but the best deals seem to be deals where a public company is selling off a piece of itself. Why do you think that is? Why do you seem to get the best deals? This happened in Tata Motors for Jaguar Land Rover from Ford. They got them at a bargain price.
Usually the seller is desperate to sell.
Or they have a strategy that says, you got to get rid of these bad businesses at any price. Absolutely stupid advice, but they take it. And one of the things we're going to talk about in the next session is why selling a bad business might actually lower your value as a company if you sell it too low a price. And finally, we look at growth and cost synergies. There were 70, so this is a McKinsey study, 77 mergers driven by growth synergies, only 30 delivered close to what was expected. Whereas cost synergies are much, much higher percentage, 66 out of 92 delivered close to what was promised. Easier to deliver cost synergies than growth synergies. So here's the bottom line on synergy. The odds of success are low across all mergers. But if you can stay disciplined and you can stay focused, you know exactly what you're going for, I think you can create value for synergy, but you need to be willing to walk away from it if the price gets too high. If there's one message is without that power, you lose the capacity to do good deals. You need to know the reservation price, like if the price got too high. So for acquisitions to work, you need to stay disciplined. It's really difficult to stay disciplined. You need to figure out what worked for you. For Cisco in the 1990s was buying small tech companies with promising products, converting them and delivering value. It worked incredibly well. They went from a $4 billion company to a $400 billion company in 10 years. This is a case study for success. It became a Harvard Business School case study. Then you know what happened to Cisco in the next 10 years? They went from 400 billion back to 100 billion because they kept doing acquisitions and it wasn't working anymore. They didn't know when to stop. And that's, I think, the key. You're going to build an acquisition-driven strategy. You need to be disciplined and you need to know when it stops working. Because you keep pushing it, you're going to end up exploding this process. So I know it's a pretty depressing summary of acquisitions, but I think there is a glimmer of hope. You want to build an acquisition-driven company, there's a way to do it. But you got to stay in that sweet spot of buying small private businesses and building them up. Roll-ups are a classic example. If you do it right, there's still value to be made. So I will see you on Wednesday for the last segment of class.
Actually, from your graduate class, I just watched this because I haven't been doctor corner for my undergrad. I just wanted to ask you were talking about the Brazilian, call it capital. And